How to refinance. Let's first define what refinancing is. When you replace one loan with another, typically the aim of locking in a better interest rate, lowering your monthly payment, or accessing your equity in your property. So there are different ways and different types and also different reasons to refinance. In this video, I will be discussing how to refinance and then also different types of refinances that you could do in order to accomplish your said goal, right? I'm Kevin Jefferson, the People's Lender. If you're new to the channel, do us a huge favor and hit the subscribe button so you can receive notifications on when we release videos. And if you like this video and the information that you're going to receive, do me a huge favor and give me a thumbs up so we can push it out in the YouTube algorithm. So first of all, we're in a current market where rates are starting to decline. And when I say starting to decline, that means interest rates are starting to get lower. And within the last 24, 26 months, people have been getting higher interest rates than normal. Some around 7, even in some instances, maybe 8% interest rates. Knowing how to refinance and if you can refinance and what refinancing is very important for you to make that decision. So like the definition says, one reason why people refinance is to lock into a lower interest rate. If you currently have a 7% interest rate and you go to do some sort of refinance, then you could potentially lower your rate. By lowering your interest rate, this could help you lower your monthly mortgage payment, as well as if you have enough equity in your property, you have the ability to potentially get rid of mortgage insurance private mortgage insurance if you currently have it, meaning getting rid of mortgage insurance if you have an FHA loan, private mortgage insurance if you have a conventional loan. Another reason is you'd like to do home projects, right? You want to go earn some equity in the property. While lowering the interest rate, you'd like to take some money out of your property so you can do some projects or some touch-ups around the house. To me, typically when you're refinancing and pulling cash out refinance, that I always tell clients this is going to be the cheapest money that you can get in order to refinance, or getting money to do projects. The other reason is you could be refinancing to consolidate some debt. What I mean by consolidating debt, if during the process of gaining equity in your property and being in your property and you've accumulated some debt, credit card debt, personal debt, doctor's bills, and you want to try to get rid of or alleviate those debts, you could potentially refinance and pay those debts off. That's what you call consolidating your debt. Now, instead of having hospital bill, credit card debts that you're paying out on a consistent basis, you roll that all into your mortgage loan. By refinancing, those get paid off. You now have typically you're going to have a higher mortgage payment, but you've got rid of that debt and everything's consolidated into one. So that could be a potential benefit to getting rid of some debt, freeing up some money monthly, allowing you to also be able to do other things. So by refinancing your property, I do want to make sure you understand that you're going to have a few things change. You could potentially have a different term for your refinance, meaning if you had 20 years left and you refinance and you may have extended it out to a 30-year to help, one, lower your payment, two, by lowering that payment and debt, it could allow you to qualify for more equity to get out of your property. So refinancing could start your terms over. You also could refinance and lower your term based off of your current situation. Meaning, let's say you purchased your home 2 years ago and you had 28 years left, but you decided, hey, I'd like to see what I'd qualify for if I lower my interest rate and my payment. I'd like to see what it looks like if I lower my interest rate, but then I also look at a 25-year term as well as a 20-year term, which means you now have 25 years or 20 years that you could have to pay off your current mortgage, right? Those are other options as well. Along with starting your term of your refinance over, there's a huge myth that I want to make sure I dispel. There's a myth that it does not cost to refinance your home. while in some instances in different types of refinances, you may not have to pay per se out of pocket. The cost that you're paying will come from the refinance or the equity that's in your property within itself. So there is some sort of cost incurred in refinancing. So when you're refinancing, you have to remember there are fees that the mortgage company charges, processing and underwriting fee. There are attorney's fees that have to be redone because you have the mortgage, you have to redo title, has to be redeeded. Maybe you're taking someone off of title. Maybe you're adding someone to the title. All of those things have to be redone. There's taxes and prorations that have to be done. There's mortgage insurance that has to be redone. So there is a cost associated with refinancing. However, the cost is typically not as much as this if you're purchasing a home. But again, it also depends on what type of refinance that you're looking to do. Now, the different type of refinances that you could do is you could do an FHA Streamline refinance. That refinance costs the least because you're just going to get rid of the interest rate. You're going to go, if you currently have a 7% interest rate, you can go down to, let's say, a 5.75. You get that changed, your terms. You could potentially keep the same terms, or you start over with a 30-year, but you're not pulling out any cash. And typically in a Streamline refinance, you're going to bring somewhere around 1 or 2 months of your mortgage payment. Depends on when you close and how things are set up. Another type of refinance is a rate and term refinance. Very similar to the Streamline refinance, which I want to make sure in the Streamline refinance, there is no appraisal needed, right? In a rate and term refinance, what you're doing is you're taking some equity out of the property to pay for the closing, and you're getting better rates and better terms to lower your payment. And you're also, in the rate and term refinance, you have to get an appraisal done in a rate and term refinance. Then you have your cash out refinance. A cash out refinance is a full-blown appraisal, all docs, all paperwork. It's going to be a full documented refinance, because what you're doing is, in some cases, you could be looking to get a better interest rate, or your interest rate may increase, but you're doing it to get money out. So you will need all of your documentation. You'll need pay stubs, bank statements, W-2s, your current mortgage statement. You will need your current bill, tax bill, as well as homeowner's insurance declaration page. And a full appraisal is done on this to see, and you'll see how much equity is in the property, which will allow for you to pull out some cash, or allow to let you know how much cash you have to pull out after the mortgage is paid off, the closing cost is paid, and the attorney's fees is paid, and then whatever's left can come to you. Those are the FHA refinances. So you have FHA Streamline, which is very low document, no appraisal. You have rate and term refinance, which is some documentation and appraisal is required, but you're not pulling out much cash. And then you have an FHA cash out refinance, which is a full documented refinance, and it's an appraisal required. Now with VA, you have something called a VA EARL. The VA EARL is a type of refinance where the interest rate is lowered, and it has to be some sort of benefit to the veteran. You have a conventional refinance, which you can refinance and you can pull out cash. So you can do a cash out refinance with conventional financing. You can also do a rate and term refinance with conventional financing. You also are able to do a refinance with a USDA loan, where you're not pulling any cash out, but you can do a Streamline where you're getting a better interest rate and it's low documentation, as well as you do not need an appraisal in that situation. Another myth I want to make sure I dispel with refinancing is you have to wait to refinance. So you typically have to wait until you've owned the property for 210 days. That is not a mortgage company's rule. That is the rule for FHA, VA, USDA, and conventional financing. You have to wait till after you've owned the property for 210 days. Typically, you hear people say after you've made 6 payments, 6 on-time payments, and that's right. 6 on-time payments, and where the 210 days comes from is you typically skip a month, which that is included in the time frame. It is part of ownership, so you have that 30 days that you skip, plus the 6 payments that you've made, which typically is 210 days from when you've purchased a property. So you can't get a loan. If you purchased a loan in August of 2024 and now you want to refinance in December, if it's a FHA, VA, USDA, or conventional financing, if you want to refinance because rates have dropped in December of 24, you're not going to be able to do it because you have not owned the property for 210 days. So we've talked about, and I've explained how, the different types of refinances. What you also need, you will need documentation for most refinances. I spoke about that earlier, but I'm going to reiterate what I said. So when you're doing a cash out refinance, whether it's FHA, conventional, you're going to need the same documentation you would pretty much need when you purchased a home. 30 days, most recent pay stubs, 2 months, most recent bank statements. Also need your 2 years most recent W-2s. If you're self-employed, you may need your 2 years most recent 1099s, as well as your federal tax returns, all pages and all schedules. If you own the business and you W-2 yourself, we will also need your business tax returns as well as your personal tax return, along with a copy of an unexpired driver's license and Social Security card or your passport. So, well, Kevin, why do we need all this stuff? Because you're refinancing. You already own the property. That's the first part. But just remember, you're financing it over again, and they want to make sure, hey, yes, this person owns this property, but can they refinance? So one of the biggest things and mistakes that people make when they go to refinance, or they know that they want to refinance, is they take on more debt. They may not be able to refinance because their debt's too high, or they don't have enough equity to consolidate that debt that they've taken on. Therefore, they may not qualify for a refinance. So, I haven't forgotten. I told you at the beginning of this video to stay till the end so I can give you some tips. So, another huge tip that I need you to do is 2 things. Don't bring on any more debt, which I previously spoke about. And the other thing is make sure your credit score does not drop. Not all refinances need to pull your credit score. The Streamlines, the FHA Streamline and the USDA Streamline, as well as the VA Streamline, they don't necessarily need your credit score. They need your mortgage history and your mortgage score. So when you're refinancing, you have to make sure you don't have any late payments in the most recent 12 months, right? So you have to make your payments on time. The other thing is, while in those cases, you don't necessarily need your credit score. So when you're doing a cash out refinance, rate and term refinance, your credit score does need to be at a certain point, depending on the lender, depending on their criteria. Typically, a 580 credit score is potentially needed. However, sometimes it could be higher depending on your terms and conditions. So you want to make sure that you keep your credit score on point. Make sure that you don't have any lates or don't accrue any type of lates while you're in this process. And if you're purchasing a home and you're buying it at a higher rate, and at some point you want to refinance, you want to make sure you keep yourself in position to be able to refinance, because the biggest thing is, and the biggest myth is, because you own the home does not mean you automatically and are guaranteed an approval for a refinance. If this information has been helpful, I need you to do me a huge favor. We have a weekly newsletter that we would like for you to subscribe to. For subscribing to our weekly newsletter, below will be a link. We will give you a free home buyer's guide to walk you through the process of purchasing a home. I'm Kevin Jefferson, the People's Lender. Also, we have a Facebook group that we would love for you to join. The link will be below as well.